What's up, guys? On today's episode of Full Signal, this is a must-listen conversation with Jay Woods. He is a 30-year veteran of the New York Stock Exchange, and he's the chief market strategist at Freedom Capital Markets. In this conversation, we talk about his favorite sectors for the new year, what stocks could do with the new Federal Reserve chairman, and where he's looking for opportunities in the market outside of the Magnificent Seven and technology. This is a fantastic conversation, and I learned a ton from Jay. I think you will too. Jay, you've spent decades at the stock exchange, center of the financial world. The biggest thing right now is the AI trade, whether we're in a bubble. What are your thoughts on this?
We could look back in history and say we were in a bubble. And one thing I know about those historic times, when you're in a bubble, enjoy it. There's a lot of money to be made. And I think there are pockets of bubbles. We've seen them this year just play out. We've seen that nuclear trade and the Oklos of the world go explosively higher, come back in. They're still up tremendously for the year. Quantum stocks, the Rigettis of the world, it's up 1,000% back-to-back years, yet it's 50% off its high. So it's had corrections. So there is froth in this market. We've seen crypto take a step back and crypto-related stocks. But what it is a rotational bubble, which I love, because when you're talking bull markets, you want to see rotation and you don't want to see one sector, seven stocks, as people like to point out, lead. And I think this has been a healthy market. And if this is a bubble, I think we have some room to run, and this is a great thing.
What do you make of people saying the market is rotating and breadth is broadening? Because I get people telling me both things. I hear this is a super narrow market, but then I also hear, oh, look, it's getting healthier. Where do you fall on that? Yeah,
no, I'm a big believer as a technician that rotation is the lifeblood of a bull market. That's a great quote by Ralph Acampora, who founded the CMT organization. And what you want to see is leadership. The leadership you want to see is technology, communications, discretionary, those Mag 7 stocks. But when they start to pause, you want to see other sectors bring up the rear. And when that happens, that means money's not leaving the market. It's just rotating to sectors that are lagging. I look at sectors like the transports about to break out. Healthcare has been a dog for a year and a half, coming back to life. And the healthcare has three different sectors that are slowly coming back to life. So we've seen some of the Mag 7 lag. In fact, 5 of them are lower than the S&P 500 on average this year. And we've seen rotation within the Mag 7. That is healthy. So the overall trend in the S&P 500, as we deem it the market, continues to go higher. So when you get rotation, it's good. What you hear people, the skeptics out there say, oh, it's just 7 stocks. At times it was just 7 stocks lifting us up. And yes, it's a little troublesome. But when you look at the S&P equal weight versus the S&P now we're seeing both break out to 52-week highs. That's positive. That's signs of strength. And last year, all 11 sectors were up. This year, all 11 sectors are up. Staples may not be by the time this airs, who knows? But the market overall is healthy. And I think the story of that Mag 7 is starting to finally change.
Change as in because of the 5 laggards it's changing?
Well, because other sectors, other stocks are picking up. And no one talks about Broadcom. No one talks about Berkshire or JP Morgan. Walmart cracking the top 10 and Walmart having a rather flat year. These other companies are trillion-dollar companies now, and they're starting to pick up. And then within the Mag 7, Apple isn't having that explosive growth, but it's slow and steady. It's a $3.5–4 trillion company. When Microsoft falls, Google leads. There's a lot of rotation, but the Mag 7, I think, has been given too much credence, but given its weighting, given the run it went on, that was great. But I think the story in 2026 is, what are the next leaders to emerge? Will Palantir continue on its trend? That's one thing I want to see. It's halfway to that $1 trillion club. As one of your former guests, Dan Ives, says, it's going to be a $1 trillion company. Well, let's hope Dan is right. As my son owns Palantir. I'm rooting for him. But I think 2026 is not going to be just those 7 stocks. Yes, they are going to be focused because of their size and because of the scope they have in the industry, but you're going to see other sectors start to show strength. We don't talk about the financials. Financials have been up 2-3 years in a row now. We haven't seen the XLF up 4 years in a row. ever in the 20-something years the XLF has been there. So let's see if the financials can continue that winning streak. I think the groundwork is there for them to lead. And, the shine of the Mag 7 is going to continue to falter. We'll come up with a new acronym sometime, and then we'll talk about that.
So my latest stat I saw was the Mag 7 is about 36% of the S&P 500. So my question is, even if other sectors pick up, does it even matter on a index level?
It doesn't at first. It should be a gradual change over time. That 36% out of that top leadership group took time to get there. And when you see that stat, yes, it gives you pause like, okay, wait, we have too much in one basket. In fact, each ETF has too much in one basket, but they do reshuffle the deck. We will see some stocks fall. Meta took a huge hit over the last 3 months, starting to rebound a little bit. But what picked up the slack? Google broke out. So, and I call it Google because it changed your symbol, and like Meta is Meta because it's no longer FB. But I digress. It's just one of my biggest pet peeves of the market. We've seen rotation. Now we're going to start talking more about Broadcom. We're going to start talking about Palantir. We're going to start talking about Goldman Sachs, which is the biggest weighting in the Dow because they never split their stock. I wish they would. And, other big names coming along that will slowly whittle away at the ranking of those top 7-8 stocks, and it will balance out, but it takes a little time.
So you mentioned something to me the other day. You said rather than the Mag 7, they could be called the Lag 7.
Yeah.
Is that a forecast? Or?
I'm a technician first. I was looking at the charts, and Tesla's got me really intrigued going forward. This thing looks like it could go, and Tesla's a whole nother animal to itself. But when I say the Lag 7, 5 of the 7 stocks are lagging the S&P 500. If you predicted 2025, all right, we're going to close of the year near 6,900. We're going to be up another, 15 to 20% on top of what we were. And 5 of the Mag 7 stocks are going to underperform. You would have been like, well, how are we going to get this strength? We got it from the other sectors that have been doing so well, and some of the technology names that have really continued to thrive. I mean, the year before recently, Oracle was having unbelievable. Broadcom, just a whole slew of new tech names starting to really eat away. I think the theme next year is, what are the winners? What are the losers? And it's starting to play out right now. When we see, now Google's a winner. 6 months ago, Google was a loser. It was over. Search was dead. And now Gemini's crushing it. Now it's an NVIDIA killer. So we're going to see headlines like that. And when narratives shift in this market, the biggest change over my career is the speed at which they shift. Things move quicker than ever before, and the headlines keep changing. And then a whole Trump administration, I mean, you write a daily, and like, I bet you go to bed and you wake up and you want to throw it out because something happened in a tweet overnight that made you change that narrative. So I think we're still going to get a fast news cycle, and we may see some big changes like we saw from NVIDIA sideways consolidating, constructive, but Google making the run it has. You're going to see other pockets, and my job is to do more research and figure it out. So I come back real strong with ideas, but I have a few now.
You always have a ton of ideas. One idea I want to ask you, what do you make of the comparisons to the .com? Because I know you were trading at the time.
Yeah.
You know it intimately. What's going on?
So being on the Florida Stock Exchange, for those that don't know, I was a trader there. I got my seat in 98. And before 98, I was a clerk in some of the busier stocks. And I was there when Gateway was going nuts and Compact Digital Computer, iOmega. I mean, your audience is very young because you're hip, but the older people will know what I'm talking about. But I remember the traders just, this can't go on forever. This can't go on forever. There was so much euphoria, so many IPOs. It was excessive. Irrational exuberance was the words used by Mr. Greenspan back in the day, and he called it very early. I think he said that in 95. We went on to 2000. But when we say a bubble, we got to look at it. How was it a bubble? The S&P 500 was not in a bubble. As a technician, you can look at a chart of the S&P 500, and what it did is it rode above the 200-day, the 50-day, and the 20-day moving averages rather consistently. And when it got too far extended, it did pull back. When it cracked the 200-day moving average, it gave technicians, at least, some pause. And if you use that as your barometer of health, which I feel a moving average is just that. All right. We're riding above a certain moving average, especially the 200-day barometer of health. I think it was Brian Shannon who taught me bad things happen under the 200-day moving average. And he's right. And you can make some great trades, but you got to be careful. But what we saw over the .com era was steady growth overall in the S&P 500. It was the NASDAQ 100. It was the tech sector. When you look at a chart, it got explosive. And when things get 20% or more above the 200-day moving average or the 50-day moving average, you want to pull back. And as a trader, you want to take profits. And yes, have a problem saying, oh, I gave it away. These are the greatest trades you'll ever make. And, oh, I gave it away. And yes, I bought the Google IPO. I sold it up $50, 50%. And I gave it away. So not fun trades. But my goal when I entered that trade was, all right, this is going to be a hot IPO. If I can, make a quick buck, I will. Thankfully, later, I got back in and I just put it away in the kids' retirement or my retirement account, Kids 529 plan. And it was okay. But .com similarities because it's technology, internet versus the AI. Nice run in the market, but the run in .com, especially on the tech side, was anything with a symbol at one point. We haven't gotten to that stage. We haven't gotten to the stage where we're IPOing every day. There's a celebrity at the New York Stock Exchange or, the E-Trade chimp or the Gateway cow or the Anglo Gold lion up on the podium. It's not the party it once was. So I think we may get to that point. That's how bull markets tend to end, in euphoria. We're not there. When consumer sentiment is at historic lows, as a contrarian, I think this is very bullish for the market because people don't believe it. Once they start chasing it and it goes the other way, that's when I pull in my bull horns and I say, all right, it's time to take a pause. So AI, the story itself has a long way to go. There will be winners, losers, but it isn't at a point where every single stock is going up. And that's what I'll look for when, a bubble is about to burst and, it's time to say something's changed in this market. It hasn't.
Some of you may not have heard this, but our partners at Public just launched something called Generated Assets. It brings AI into investing in a way I've honestly not seen before. Here's how it works. You type in an idea like AI-powered supply chain companies with positive free cash flow, or something like defense tech companies growing revenue over 25% year over year. Public's AI then dispatches a swarm of agents that can scan every single stock, evaluate them, and instantly build a custom index around your thesis. What really stands out is how clearly it explains why each stock is included. And before you invest, you can even backtest your idea against the S&P 500, so you're making decisions with real context and not just guessing. Beyond generated assets, Public lets you invest in stocks, bonds, options, crypto, all in one place. They'll even give you an uncapped 1% match when you transfer your investments over from another platform. If you want to build a portfolio that actually reflects your thesis, visit public.com/openingbell. That's public.com/openingbell. Now let's get back to the conversation. Something I saw a few days ago, the CNN's Fear and Greed Index was all the way in extreme fear. And I think we were within 1% of record highs for the S&P. So that, to me, there's such a big disconnect in sentiment and, let's say, the market prices or even the fundamentals. So when I hear the .com comparisons, not that I was a trader back then, but from my study of it, it seems a little flawed. Yeah, it is. And the fear was the long-term traders who didn't understand, how do we keep going up? The greed was everybody who could now trade at line at home on their computer, CNBC ratings through the roof, showing every IPO. It was a fun. The 90s were great. I mean, the parties that we had, epic. The Yankees went on a tremendous run. Maybe that is a sign. I don't know. It was the Yankees in Kentucky. Kentucky won as many national championships back there in college basketball. But I understand the comparisons, and I think they're very fair to make. But to say we're in a bubble that's about to burst, no, I still think there's a lot to play out when it comes to the technology because we've seen the spend. All right. Now, what do we do with that spend? And that's why Meta got hit. All right. Yeah, we have we're spending. Microsoft, we're spending. Okay. Where are the results, guys? Let's go. And that is what's going to be the game changer. Meanwhile, Apple,
not really spending, slow and steady. Apple's more utility and a staple than it is a tech stock, but that's another topic for another time.
Well, what do you make of opportunities outside of technology?
Yeah, I think there are a lot of opportunities. And one of the things I looked at are beaten down stocks, and you know the ones that we know: Nike, Starbucks, Disney. When are these things going to turn around? And we're showing some signs of bottoming, but I'm not ready to jump in on a Chipotle right now at $30. But you know, it's tradable at these levels. I don't know if it's going to turn around. Sectors that I saw turning around a while ago: regional banks. The financials. The financials have made great rebounds in this market, continue to be in that uptrend. And then you have regulatory tailwinds at their back. We just had the SEC commissioner ring the bell at the New York Stock Exchange, Commissioner Atkins, and, you know, make IPOs great again was his theme. And like, IPOs are great. You don't have to make them great again.
Sounds frothy.
Just make them happen a little more often. There's a lot of paperwork and there's a lot of minutia. Well, the administration is killing some of the, you know, hurdles that these companies had to clear to go public, but they're doing fine in the private sector. And if I'm a private company that's doing well and raising whenever I need to, why go public and then have to be at the scrutiny of all these analysts and worried about your quarter? So it's a very different environment. Back in .com, they were going public early, like Amazon was still early in its infancy. Yeah, and look at what they've done. So I wish more companies would take that plunge on the early side instead of relying on private equity. But you know, I can understand why they wait. And you know, we've been making new highs for 2 straight years now, and usually that's when companies want to hit the public markets. They really haven't, with the exception of a few.
Do you think that's a consequence of the public market environment, or do you think it has something to do with, let's say, borrowing costs or something else happening? Yeah,
that's a great question. I think it's a little of both, and that's usually up to the individuals behind it and the money behind these companies. When Reddit went public, you know, people are like, oh, it's too late, they missed it. Well, that company is crushing it. I didn't know how good Reddit was, and I was mistaken, thinking, oh my God, these guys were too late. They should have gone during COVID. And then the companies that went during COVID, they had that euphoric run, the SPACs. That was another story. But the companies now that have gone through COVID are starting to come back. Zoom, talk about turnaround stocks. It's trying. Get above 90 Zoom, and you got me technically. You just can't stay above there. But it has a long base. Other turnaround sectors, medical devices. We've seen healthcare. We've seen the drug stocks starting to come back, except for Pfizer, which is the biggest dog in the world. How do I know this? I've owned it for 20 years. It pays a great dividend. It was a short-term trade that turned into a long-term idea. But we're seeing the drug companies start to turn around. We're seeing biotech really explode. We're going to see M&A activity continue in biotech. Biotech, very risky because most of these companies are tied to one drug, one passage from the FDA. That is very high risk, but the trends have changed. Something's going on. And then medical devices. Medical devices have finally turned. The big 3 in the medical device sector, the Abbott Labs and the Intuitive Surgicals of the world, haven't. But underneath the surface, when you look at the IHI ETF, which is medical devices, you're starting to see IDEX Labs break out of a nice base and move. Medtronic trying to break out and go higher. These are names that I like, that aren't really being talked about because they're not deemed magnificent. And, you know, quite frankly, they're boring. Who wants to talk about Steris, you know, and, you know, surgical sterilization devices? But these are solid companies that are finally turning around that will, you know, hopefully see strong uptrends going forward the next 6-12 months easily.
What are the indicators or maybe the macro factors you're looking at as stocks go into the next year?
Yeah, that's a great question. So, you know, for me, someone that was a day trader, a market maker on the floor, my time frame has changed. So when I talk about stocks, I try to go intermediate term, 3 months, 6 months. Macro effects, 2 things. Fed policy. What is the new Fed chief going to be? Does he get everyone on board? How aggressive do we cut rates? How does that affect inflation? That's one. And then, you know, with the housing market, we still haven't seen that turn. I think this is the new normal, 6%. I'm talking as a boomer. I apologize, but 6% used to be really good. It's just the new normal. But the housing prices haven't coincided, so it's tough. And then the biggest X factor for me right now as we end this year going into next year, I don't know when the Supreme Court's decision on tariffs is going to be, but this has the ability, if they deem these tariffs illegal, to throw a major monkey wrench into what's going on in the economy. Meaning, Costco, perfect example. They just filed the preliminary lawsuit. If they're deemed illegal, they want their money back. Okay, who else is going to want their money back? How is the money going to be returned? What is the administration going to do to pivot? Because I don't know if you're aware of this, the president likes to tariff. So he's going to try to find a way around it. What was the one thing that caused the most uncertainty this year? Liberation Day, that chart. Now, here's a fun fact. I was on the phone with Jess Menton of Bloomberg, and we were talking as the tariff Liberation Day chart was about to be unveiled. Wall Street Journal had a rumor, it reported it's going to be 15% across the board. Clearly, they didn't see the big, beautiful chart or whatever the heck they call it. And when that chart came out and we saw like 42% numbers with countries we didn't even hear of, that caused uncertainty. And what do we do in uncertain times? We panic and we sold off. That brought up the taco trade, which is one of my favorite trades of the year. We didn't get those 100 deals in 100 days, but the uncertainty caused angst. The angst caused a pivot, and then we've been slowly recovering it. If we have to repeal these tariffs, every CEO at these S&P 500 companies is going to have to readjust. Second quarter, they talk tariffs. Third quarter, fourth quarter, we didn't hear them talk about tariffs. And the numbers, they were lowered. The bar was lowered. They've been beating. We're seeing growth. Things are going well. If we have to pivot again on tariffs, we have a problem. And then when you look at Trump 1.0, 2017, his first year, guess what we did? We were up every single month. Crazy headlines. We were up every single month. Slow, steady, boring market. It was a tough market to trade. 2018 is when all hell broke loose. What happened? China trade war tariff policy. And that's when we had a near 20% correction. We didn't get it on a closing basis. This year, 20% correction intraday, but 19.8 on a closing. So not officially a bear market. It's so tariffs and this SCOTUS ruling could really throw a monkey wrench into the beginning of the year when it comes out.
I am going to push back on you a little bit.
I hope so. That's what the market's all about.
Well,
Let's go.
And not even pushback, but I've been looking at this market and there is so much uncertainty going on. You have the AI bubble fears, you have the .com comparisons, you have this idea of circular financing, you have tariff uncertainty, you have labor market falling apart. And yet we're within 1% of all-time highs. So all that uncertainty hasn't been able to derail the bull market. So maybe, if we pitch ahead a little bit, more uncertainty, is that really going to make that big of a difference?
Well, let's put it in another perspective. We're not even one of the best performing markets globally. When Peru is up 66% and Greece is doing so well, this has been a global economy, and the European markets and the foreign markets the emerging markets have been doing extremely well. We are doing great. And we started this, by the way. So don't let me, say, hey, now let's go out. But there are opportunities in other places. Yes, I understand, the nervousness and why people, are pushing back, but the growth is there. We're going to be fine. But when you get that tariff uncertainty, people's logic goes out the window. And when there's a little bit of fear in this market, going back to something we talked about earlier, we always take those stairs up and that escalator down. And we saw it in April, and we may see it again if there's something that comes out of nowhere, because everyone predicts what's going to happen, but you never get hit by the bus you see coming. The tariffs are going to throw us off. This is going to throw us off. And then all of a sudden you're in a global pandemic. Well, I didn't have that on my bingo card. I don't know what geopolitical event will happen, but the ones that I can anticipate, I think this is how the market will happen when those things arrive. But yeah, that's what's great about this job. You come in every day, you never know what you're going to get. It's also the worst thing about this job. You come in every day, you don't know what you're going to get.
That's markets.
Yeah.
What was your initial reaction during Liberation Day? Because I've seen a bunch of stats.
Are we allowed to curse?
Yeah. Well, if you held through it, you're up almost double digits in the S&P. And if you sold at the bottom, you've missed out on on the big rebound. So how were you looking at that in that moment?
Well, my initial reaction was WTF, what just happened here? And then, of course, what I do as a technician, I look at levels, I look at charts. We broke down every support level, 200-day moving average. We were oversold. There was a panic. So you look for opportunities to buy. The first time I want to buy, I put in low bids. I call them low ball bids. And I put in 5. I got hit on 2. Broadcom and NVIDIA. Yay. And Broadcom, I bought at 142. I sold it at 177. Look at me.
Wow.
I'm trading at 400 right now. Yeah, shoot me. But that was the trade. That is what I did. And as an analyst, what did I do? You always remain calm. As a trader on the floor, I'm bald for a reason. I didn't remain calm. But back now with my analyst hat on, you take a step back and you look at different scenarios. What does this remind us of? And to me, it reminded me of 2018 when Trump was fighting and the Fed was fighting and there he was going against Jerome Powell. And now here he is, doing the same exact thing. All right, how bad can this get? And then when Trump says, I don't care about the stock market, stop. All right, this guy he autographed a copy of the greatest rally in his regime. It was after we were down 3,000 Dow points and went up 2,000, and he autographed it. He follows it. So if the market's going to tank, he's going to have enough people in his ear, and he's going to readjust. So as long as there's not that COVID-like event, which I can't anticipate, I think this administration does look at the market as their report card. And if it gets a little too crazy, they adjust. And, now with a little more Fed influence, it'll be very interesting to see how it plays out in 2026.
Well, if the Fed comes in with, let's say it's Kevin Hassett or another Trump favorite appointee, interest rates are coming down.
Mm-hmm.
I think they're going to come down more than the market's letting on right now because it's going to be a new Fed chair.
Yep.
To me, that says asset prices are going higher just because rates are coming down. What do you make of that?
Well, that's the fear that not just asset prices, but the prices of everything we buy because, oh, wow, we can raise prices. Inflation's coming down. It doesn't work that way. We are still in this COVID hangover where things went too far on the pendulum one way and then too far back where we're still normalizing. To get to 2% goal is going to be very difficult if we are going to be cutting rates. I like the fact that rates have remained stable. I like what Powell has done. And it's going to be fascinating because it will be a pro-cut leader at the helm. But one thing we've noticed, and Powell has kind of stayed quiet, he's let the Fed officials speak more than they've ever spoken. And I don't know if it's a good thing or not, but it's definitely something he wants them to do. We see dissension. We see how they talk and what actually goes on in that room. So I don't know if it's a good thing or a bad thing, but if it's Hastert who takes the helm come April, May, it'll be very fascinating to see if he can lead and get everyone on board. But as far as inflationary concerns, that is my number one concern because if they cut too far too fast, it's not good for monetary policy in the sense that we're going to see inflation definitely stay at 3%, which is to them like the new 2%, because now things come in line at 3%. Oh, this is great. Okay, no. If 2% your stated goal, let's try to get it there. Unemployment historically is still okay. But we have had such a low trending level between 3.5 and just under 4.5 that, if we tick up a little above that, it causes a little bit of a panic. And I'm not an expert on Fed policy, but I'm an expert on watching the way they talk and how the market reacts to what they say. And it's going to be very fascinating when Jerome Powell is not there because it is 12 people in the room. And what Powell's legacy is, he's going to dictate over the next few months. And if his legacy is to let the people in the room speak and let them talk about it, maybe he's setting it up to kind of push back on, we're not just focused on, the unemployment side of things. We're focused on inflation and we have to get it under control because it will go higher if we really start to cut aggressively.
So just to follow up on that, Do you mean his legacy will be to give the other voting members a bigger voice? Yeah,
I think so. I mean, he is finally said, we've had the minutes, and so we have an idea, and they do the speaking rounds after the blackout. So you kind of know, but we've had dissensions on both sides now. This did not happen before Powell in several years when we had 2 dissensions. And now, every Fed speaker that's being appointed is trying to appease an audience of 1, which is the president. So people are trying to make their opinions known, and we'll see how it works out. Stephen Myron is there till January, but he went in there. He made his opinion known. He dissented. He made the speaking rounds, and he said, I wanted to cut, just look at the dot plot. You have dots in the normal range, and you have Myron all the way down here. So that will be the interesting thing. So I think Powell is allowing them to speak more, so the economic world, the whole world, can see exactly what is going on here. And, it's not just cut to appease one person, because, lower rates will be helpful, but it's not going to be, the great, panacea that the president thinks is going to be, and solve the mortgage crisis and get everything back humming. It's great for some of those big companies and the borrowers in the world, but it's not great for the overall economy.
I have not heard anyone talk about Powell giving a greater voice to his voting board members.
It's the last 2 months. It's very weird. And that was the one thing I've been picking up on him, that when he said this wasn't an easy decision and there was dissension in the room, and then the speaking rounds, they are making sound bites every single time they go. The fact that we know all the names of the Fed governors, we're a sick breed. We may know that, but you're hearing, Williams of New York Fed, oh, wow. And Michelle Baumann, a couple dissents. She was up for the lead. We shouldn't know them. They should be kind of quiet, but it's a different kind of Fed right now.
Real quick, we'll get right back to the interview. Just wanted to pop in and say, if you like this content, I write a newsletter every single morning called Opening Bell Daily. I cover macro, the stock market, asset prices, why things are going up, why they're going down. And if you want to get that for free, you can sign up at the link in the description. Let's get back to the interview. What do you see happening what do you think is the bigger risk or input for asset prices next year? If we get really low rates, or maybe the opposite side of that is if inflation starts coming up, do stocks react negatively to that?
It will hurt specific sectors dramatically, because it always comes back to you and me, the consumer. We've seen staples get destroyed, and staples, you don't want to see lead. That's usually where you go in tough markets, but to this stretch, which staples have been getting hit, it may be time to put a few of these staples on your shopping list. Talk about stocks that could turn around. Looking at Procter & Gamble, it hasn't done it, Clorox. But, I don't know. This economy has really been able to readjust and continue to thrive. We keep hearing K-shaped economy. The people that invest in this market are doing extremely well. And so the stock market may not be a true representative of what is going on in the rest of the world, but as a stockholder, as someone that wants equities to go higher, these companies are continuing to grow and, beat those metrics. We have not seen any pullback. The retail sales numbers coming out this Christmas time, Black Friday, Cyber Monday, there is no slowdown. What I look at are delinquencies in credit card payments, car loans. Those are starting to tick up. That is concerning. Let's see how bad that gets going forward, because that's just one part of it. The key to me is the housing market. If we can just get it to cool a little bit, there's a group people a little older than yourself ready to move out of the house. I've got a son. I'm ready to have him move out of the house. And it's a tough market for a new homeowner to jump into. I don't think this 50-year mortgage was a good idea, but we'll see if that helps a little bit. We'll see.
Yeah, there is a huge affordability issue right now. And inflation obviously would not help that if it starts ticking up in the new year. What do you make of, if the president is looking at the stock market as a report card? It's been a very long time, in my opinion, since the stock market has represented the economy.
Oh, yeah.
I don't know if that's ever going to converge again, or if there's ever even been a world where that was the case. How do you think about that?
No, and I've gone on some networks and I said the stock market's not the economy. The economy is not the stock market. The stock market tells you where it thinks the economy is heading. It's that voting machine that leads us. And right now the market continues to climb higher, but we're stalling a little bit because we're not sure that the growth will continue and the spend is going to lead to growth AI or IE, AI is such on the brain, Meta and why that stalled, and Microsoft, why that stalled. So yeah, it's a very perplexing time, because when you have a president that uses it to judge, who is driven by making money, investing in companies now, Intel, and what I did, and I thought the inauguration was the tell. Look who's in that room. These are the most wealthy, influential people there are. Now, he and Musk had to blow up, but it's going all right. I think Musk is going to be just fine in a little while. But those are the people that gets his ear, and then he can kind of, okay, we want to help out Intel. We want to help out this. He does have that pro-American first logic to him, but it doesn't really skew, because it also helps some of his personal goals and some of the people that they are deemed his friends. So it's a weird time, and unlike anything I think we'll ever see. And it's going to be interesting to see how it plays out in 2026. I know there are a lot of analysts, and I talked with our friend Sam Rowe about this just the other. With the targets are through the roof this year, and that gives me pause. I haven't given a target, and I think I have to, but and I'm not going to give it to you right now live, but there's too much excitement from the analyst community that makes me say, well, why? Like, when everyone's on this side of the aisle, I try to go to the other side if I can come up with that logical reason. And I don't see a logical reason why this bull market can't continue, but I can see it continuing with smaller numbers, a flat year, instead of, another 20-25% rally like a lot of these analysts have been calling.
Do you have a favorite sector going into the new year?
I do. I don't know if it's a favorite. Financials favorite from a stability trending point of view. They're not going to be the leader next year, but they're not going to be the laggard. The financials just continue to chug along, and I'm talking the Goldman's, the JP Morgan, Citi. When I look at charts, I look at that Citigroup chart, and that stock just broke out last week. This thing looks like it wants to run. This thing, it's a stock, it's a company, people work there. It's so horrible how I say this, but Citigroup looks like it wants to run to the 150 level. Will it happen tomorrow? No, but over time, these stocks take time to run. So I think the groundwork is laid for the financials to continue to do well. The regional banks finally breaking out, coming back. We've seen M&A activity there. Then I'm stalking sectors that have been lagging. We've seen healthcare lagging, energy. No, we forgot about energy. I look at ExxonMobil. ExxonMobil's trading just under 120. Look at the chart on that. 5 years, it's done nothing. 5 years. Well, it's done nothing. It's near all-time highs. And guess where oil is? Under $60 a barrel, 58? Is that where we are now? I don't follow it enough. I'm following Bitcoin all over the place. I should be following energy. But the energy names have been kind of dormant. And this is an administration where we were drill, baby, drill, and it hasn't, it's gotten the price of crude down, which has been great. But these energy companies have been able to absorb it. And I think they're poised to break out. And when they do, you could see a quick move. Small caps drive me crazy. I hate talking about them. I'm always wrong. I mistime them. They're breaking out, then they fail. The Russell, I look at biotech within the Russell. I still think that's going to be strong. That's about 13 to 15%. Why didn't I just say 14? But it's in that range. You look at the regional banks, another big portion of that. And then I look at the transports. Transports also lagging. I hate the airline sector. It's very cyclical. Those charts, hey, 3 months up, 3 months down. But overall, the transports are starting to put in a nice base, and we're seeing some pockets of strength there. This is good for all old Dow theorists, where you want to see the industrials and the transportations, the things that make new highs together. That is really signs confirming a secular bull market. Transports look like they're on their verge of breaking out. Not the sexy sectors of the world, but stocks that haven't really done much starting to make noise. And then I look back, and they're not there yet. The DocuSigns, the Zooms of the world, those COVID darlings. Carvana did it, but no one else has done that yet. But some of these companies that were darlings during COVID and then came back to earth, they're basing. And if they can start to break out, Zoom so close, that could be a pocket where you see some strength because people know they're cheap. happen to discount retailers. Look at charts of Five Below, Dollar Tree, Dollar General. They have a long way to go to get back to those COVID highs, but they broke down trends, they based, and they broke out. They're up 50% each this year. There's still room to run. So those are the kind of setups and stocks that I like. But, I also like Tesla. And I don't like saying that I like Tesla, but from a technical point of view, you look at this on a monthly chart going back 5 years. If you bought Tesla 5 years ago, congratulations, you're even. But you're on the verge of a breakout, and then you put the fundamental story, Elon Musk, cult figure, but that pay package, that's the leader I want to get behind. All right, if you're Pat Mahomes and you're only getting paid to win Super Bowls and get the playoff games, that's incentive. Well, Tesla, Elon Musk has given him incentive to do well, and what he's going to do on robotics, maybe autonomous driving, we're still waiting. I think that bar is set for him to really take it to the next level. And I think he's someone to watch next year in 2026. He's been quiet since the election subsided. He went away. He'll be back. And I think Tesla may be back too.
I am also very bullish on Tesla. Jay, it sounds like you are bullish on a lot of stuff for next year.
I am an optimist. I don't think there's a narrative out there to make us go bearish. I don't think we're going to be in a recession. I don't think anything is going to derail the long-term secular bull market. But a flat year does not a bear market make. It just makes a very frustrating year for everyone who is getting used to all of these excessive gains. So to circle back to the AI and the bubble narrative, yeah, if we're in a bubble, it would be inflating a little farther, a little faster, a little more euphoria. Yes, there are bubble-like aspects to this, but I think we're going to take a little bit of a slowdown to see who the real winners and losers are, and struggle the first half of the year, finish the second half of the year hopefully strong. Second presidential year also, never one of the stronger years, but it will be an interesting year. But I look for some stocks, talk rotation, to pick up the slack that haven't been, because people are not leaving this market. They're rotating, and they're rotating within Mag 7 names. They're rotating within big tech versus up and coming tech, and they're rotating into sectors that we use every day. The transports, Avis rental car, the symbol there, another stock that looks good. These are names that we won't talk about at the bar, but they don't have that magnanimous CEO that's making the speaking rounds, but they're companies that are beating the bar. Their growth is there, and they're doing all right. So I am optimistic, but I'm not euphoric. And I think that's fair to say.
I think I fall into a similar camp. I would say I'm very optimistic for the year ahead. It's very hard for me to articulate a bear case. Mm-hmm. And, I could definitely hear people saying, well, that's when you know it's the top.
Yeah.
But who knows? I'm optimistic. You're optimistic.
That's what makes this job great.
Yeah.
I would, as a trader, only as good as your last trade. As a writer, only as good as your last article. And then you move on and you learn from your mistakes, and you try not to get too big of a head when you're, on a right path. I made a good call in 2025. I called for 6,900 at the end of the year. There's tape of that CNBC Squawk Box 1227. I feel there was a lot more luck involved, but the big picture theme played out. Tariff concern, little trouble in the beginning, then we rally, everyone adjusts. Now we may have to adjust again, and that could cause problems. But I think the growth is there, but the growth isn't everywhere. And now we're going to see the winners and losers, and we move forward. And hopefully you and I can talk more about some of those winners that we get the audience in and ourselves in, and try to mumble through those losers.
We absolutely will. Jay, can you share where people can find your work online?
Yeah. You can go to Freedom Capital Markets website. I write a newsletter. It's pinned to my Twitter handle at JayWoods3, Jay Woods 3. I write a weekly newsletter that I know you subscribe to. I subscribe to your daily. I don't know how this guy does it every single day. I write about what the week is. I'm a CNBC Pro writer. So if you are a CNBC Pro subscriber or not, the sales are on now. You can find 2 articles a week from me there. And then I'm on CNBC every so often. You never know when.
You're everywhere. All right, Jay, thank you so much, and we'll do it again soon.
Thank you. Great to be here.